Hey guys, welcome to the next episode of Morning Espresso. That was my, that was my best impression. It wasn't very good. I'm the founder of Ignite Financial. My name is Stephen Allred, and today we're gonna touch down on some Q&A. I've been going through for a while, for like a couple years now, and answering some core questions and Reddit questions, and I feel like, it's awesome, but at the same time, I'm getting drowned out, and a lot of people on there may be giving bad financial advice like you don't know. Luckily, Quora has a place where you can, in your bio, you can see who someone is to know whether you should take their advice. But yeah, and the fact that you can't sort it, so if you come along in a question, I don't know, 10 weeks after it's answered, and you have a better answer, no one's going to pay attention to your answer because they've had 140, 150 responses to their question. So I figured instead of doing that, why don't I just develop kind of this segment of the Morning Espresso series and make it a Q&A type thing. Actually, you know what? It'll be apart from Morning Espresso. It'll just be on this channel. So let's get into it. This is my handy dandy iPad. It's a hand-me-down. I've had it for years, but my mom had it for years before that. So let's talk about this question. One of the readers or posters on Reddit asks, should I sell my index fund, which is 4 months worth of expenses, to cover shortfall in savings? Good question. This is the background. I have 3 to 6 months worth of expenses invested in the market instead of a savings account. In parentheses, like I'm supposed to. This is a non-IRA, non-401k brokerage account. I have nothing in savings. The reason I did this was to achieve a higher rate of return. The S&P is now slightly ahead of what I bought it for. Should I sell it and move to a more secure location or savings account, or just keep it and work to build savings back up to 3 to 6 months of expenses? Here's what I have to say to that. He said, like I'm supposed to. Who told you that? Like, people out there are giving weird advice in financials. Like, it's blows my mind. And I understand it because you're out there searching, and there are, I think, 30 million. If you say, how do I get a mortgage? I think there are 30 million Google results for how you get a mortgage. So I don't begrudge that. It's just kind of sad because you should never, ever, 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 ever save for your emergency fund in the stock market or equities or bonds or anything like that. One, you're leaving it up to risk. So if the stock market goes down 3-5% and you have a financial emergency, what you saved in there will now be 3 to 5% below what it is now. So, or what you put in there is now 3 to 5%. It's gone. Like, you don't have access to that anymore. And you're gonna pull the money out, which is number 2. You take away from the compounding that you built up. Why would you want to do that? Compounding is everything. That's why you invest in the first place. You don't want to do that. Number 3, it's taxable. So if the stock market makes a good run, and yeah, it's in the S&P 500, so it's probably not going to just skyrocket up like investing in Apple or investing in something else that's high growth. That is not a recommendation. Let's make that clear. But let's say you invest in a high growth stock or something like that. S&P is not going to do that. But if you sell it, and it's been less than a year, you get a thing called short-term capital gains tax. And most people try their best to avoid that because it's higher. It's higher than after a year you pay long-term capital gains tax. This is not a tax advice, but just you don't want to make that choice and then lose some percentage of that on taxes when you pull it out. So not one, you get hit with the drop in the market, but once you really need it, it's 3 to 5% lower, then you have to pay taxes on the gains. And then you have to pay commission fees after that. So you're getting taxed pretty much 3 times going down, coming out of your account. So what you invested in 3 months worth of expenses is now not 3 months worth of expenses. So you should never confuse the two. Always save for savings outside. Matter of fact, most people, me included, well, most people say above 10 years, then you invest. I say reasonably is like 5 to 7. If you're planning on buying a house in 10 years, then yeah, save for it in the markets. Wouldn't really suggest that though, because housing can pop up and all of a sudden, like 3 years later, you have a house that you've been dying to buy, but you put it in the market. So I wouldn't advise that. But usually 5 to 7, 7 to 10 years, then you can say, okay, I'm gonna put this money for my financial goal into the stock market. Hence why you do 5 to 9 plans for kids' education, because it's 18 years. You have that really long time horizon. In our opinion, the upside is way less valuable than the downside in this scenario. So the downside is that you lose your money and you get tax short-term capital gains rate. If the market goes down, you get hit with that. You hit with trading fees, and then you have your money. Also, ever tried pulling money out of the market in a short-term notice and having it deposited in your checking account? It takes time. If you have a huge financial emergency that is going to take up 3 months of expenses, or if your car breaks down, or if you have a huge medical expense, like, you don't have that time, or a medical emergency, I should say, which would give you a huge medical expense. You don't have the time to go in to your portal or call your advisor or call your broker if you still have a broker, or if you're with a robo-advisor, go into the portal if you're with us, talk to us. Like, it takes time to get the money from the account selling all your positions, and then getting it deposited into your checking account. It takes time. And so while, yeah, you may earn, let's say that the annual rate of return is 6%, just hypothetically. That's awesome, but capital gains rate is going to eat up those gains. It might drop, that's another downside. And then you have to pay trading fees. So if your trading fees are $10 and what you gained after capital gains tax is less than $10 and you lost, and you don't want to take that risk. Pull it out, put it in your savings account, let it just hang out there. It's for an emergency. Just pretend like that money doesn't even exist. When you go to invest to grow your money. Don't invest to just have it sit there. Have a reason to invest. Have a purpose. If you don't have a purpose, click the link down below in our description that says meet with a financial guy. You'll meet with one of our team. Probably it'll be me. And we'll go through what your goals are and why you should be investing and how you should invest and what you should be investing in. All right, thank you guys for joining us for this Q&A segment. I really appreciate it. Have a good day.